Welcome, tax professionals, chartered accountants, and students to this explainer. Today, we're bridging the gap between the familiar taxation laws you know like the back of your hand and the brand new Income Tax Act 2025. We are tackling one of the absolute biggest updates for individual taxpayers.
So, here's the burning question on almost every tax professional's mind right now. For decades, Section 80C has been the absolute cornerstone of tax planning in India. But as we look at the new 2025 legislative framework, it seems to have just vanished. Did the government actually take away our favorite deduction? Where on earth did it go?
Well, we'll answer that today. Here is our roadmap for this explainer. 1. Introduction to Section 123. 2. Legal provision and exceptions. 3. Schedule XV and key conditions. 4. A real-life tax example. 5. Compliance and documentation. And 6. Summary and key takeaways.
Let's start with Section 1, Introduction to Section 123.
You can all breathe a massive sigh of relief. Section 80C hasn't disappeared. It's simply evolved. Under the old Income Tax Act of 1961, we obviously relied heavily on Section 80C. Now, under the Income Tax Act 2025, the direct equivalent is Section 123 read together with a newly introduced annexure called Schedule XV. Official FAQs have clarified that the nature of qualifying payments, things like life insurance and provident funds, remains completely unchanged in substance. It's really just a cleaner, more structural presentation of the law.
Moving right along to Section 2, Legal Provision and Exceptions. The magic number stays exactly the same. The aggregate deduction limit has been retained at exactly 1,50,000 rupees. Just like the old Section 80 CCE capped your benefits, the new Section 123 ensures that the maximum relief an individual can claim for these specified investments does not exceed this $1,50,000 threshold for the tax year.
Now, who does this apply to, and what are the catches? Well, Section 123 applies strictly to individuals and Hindu undivided families. But listen up, because there are some critical exceptions you need to watch out for. First, if your client opts for the new concessional tax regime under Section 202, this 1.5 lakh deduction is completely off the table. It is strictly disallowed. Secondly, there is a vital statutory precondition under Section 122.5. You absolutely cannot claim this deduction if the return of income is not furnished within the prescribed due date. Basically, filing a belated return means losing this benefit entirely.
Let's dive into Section 3, Schedule XV, and key conditions.
So what actually qualifies now? The eligible investments are cleanly grouped under Schedule VX, and the foundational pillars remain intact. Life insurance premiums qualify if they're paid for the individual, their spouse, or any child. For an HUF, it covers any member. Deferred annuities also qualify as long as there is no option to receive a cash payment in lieu of the annuity. And of course, contributions to statutory provident funds governed by the 1925 Act, along with specific mutual fund subscriptions, remain fully eligible. However, pay very close attention to paragraph 2 of Schedule XV, which dictates the cap on life insurance premiums. Applying the wrong percentage based on the policy issue date is a super common and costly practical mistake. For policies issued on or before March 31, 2012, you can deduct premiums up to 20% of the actual capital sum assured. But for policies issued on or after April 1, 2012, that limit tightens up to just 10%.
Connecting this to the new procedural framework under the Income Tax Rules 2026, we have a significant forms update. To ensure that an individual's contribution to a mutual fund actually qualifies for the Section 123 deduction, the mutual fund itself must be approved. Under Rule 3331, they must now file an application using Form 190. For the veteran professionals watching, Form 190 is your direct replacement for the old Form 59A.
Okay, Section 4, a real-life tax example.
Let's put this theory into practice. Imagine your client walks in with a gross total income of 10 lakh rupees under the standard tax regime. That's step 1. In step 2, they hand you their investment proofs, $120,000 in a provident fund and $60,000 in life insurance. That brings their total investment to $180,000. But in step 3, the statutory ceiling of Section 123 kicks in. The deduction is strictly capped. So you don't deduct the full 1.8 lakhs, you max it out at $150,000. Finally, in step 4, their final taxable income becomes $850,000. It's a simple mechanic for sure, but absolutely crucial to get right in your computation software.
Next up, Section 5, Compliance and Documentation.
Knowing the law is only half the battle. Getting the documentation right is what actually keeps you out of trouble. A massive practical takeaway here is for business owners and HR departments. Your employer payroll systems and employee investment declarations must be updated. For tax year 2026-27, which, remember, replaces the old concept of assessment year, employees must declare their investments under Section 123, not Section 80C. Furthermore, as a tax professional, you have to enforce the timely filing of returns, because if your client files late, Section 122(5) triggers and the CPC will almost certainly raise a proposed adjustment denying the entire deduction.
Let's wrap things up with Section 6, Summary and Key Takeaways. Let's distill this whole explainer down to the absolute essentials you need to remember. Keep these 5 points in your toolkit. First, Section 123 of IT 2025 is your new ADC. Second, the maximum aggregate deduction limit is still 1.50 lakh rupees. Third, always refer to Schedule XV for the detailed list of eligible investments. Fourth, remember that this deduction is completely disallowed under the Section 202 concessional regime. And finally, Form 19AMA is the new standard, replacing Form 59A for mutual fund approvals under the 2026 rules.
As we step into this new era of simplified, structured tax codes, it leaves us with an interesting thought. If the law becomes easier to read and compliance becomes more automated, the true value of a tax professional is inevitably going to shift. We're moving away from mere data entry and moving rapidly towards high-level strategic advisory. Thank you for joining me to decode Section 123. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video. Thank you for watching. Please like, subscribe, and share.